Hello and welcome. If you're passionate about cryptocurrency and the ever-evolving world of digital finance, you've come to the right place. Today, we're diving into one of the most intriguing and long-standing narratives in the XRP community, the mysterious 589 theory. Now, I know when people hear 589, they immediately think XRP is going to hit $589 per coin. But the reality is far more interesting, and it goes beyond simple price speculation. This isn't just about a number, it's about patterns, regulations, and market mechanisms that could have larger implications on crypto and traditional financial systems. Before we get into the technical details, let's set the stage. XRP has always had a unique position in the crypto market. It's not just another digital token, it's designed to bridge liquidity gaps between traditional finance and crypto markets. Because of this, every movement in XRP, whether in price or adoption, gets attention, and the 589 theory has been a part of the community for years. While some dismiss it as just hype or a riddle, there are aspects of this theory that tie into real-world financial mechanisms. Understanding this could give us a clearer picture of how XRP interacts with markets beyond simple supply and demand. Now, let's briefly talk about the current market environment. Right now, XRP is showing an interesting trend on the charts. The 4-hour chart is holding an uptrend, which signals that buyers are stepping in consistently. Technically, this is important because if XRP manages to reclaim $2 with a daily candle close above that level, it could flip major resistance into support. Historically, building a solid base around $2 has led to significant upward runs. This is exactly why traders and analysts are paying close attention this week. It's not a guaranteed pump, and it won't happen overnight, but if the trend continues, we could see steady growth over the coming weeks. It's also worth noting that market attention is not limited to price charts alone. Social engagement around XRP has been incredible. For example, a post by a user named BearableGuy123 on December 24th went viral, receiving over 2 million views and 11,000 likes. The post featured the number 589 in a visual format, sparking discussions and speculation. While some dismiss these posts as mere social media hype, the frequency and consistency of the number 589 in different contexts can't be ignored entirely. Interestingly, even notable figures in the space, such as Ripple's CEO Brad Garlinghouse, have connections to the number. For years, Garlinghouse has followed 589 accounts on social media, and various mainstream events, like the New Year's Eve celebration in Times Square, have used exactly 589 energy-efficient LED bulbs for the countdown. Now, while this may seem like a coincidence, patterns like this create narratives in the community, and in markets like crypto, where psychology and perception play a huge role, such patterns often influence sentiment and engagement. But before we get carried away, it's crucial to ground ourselves in the facts. Numbers like 589 shouldn't be treated as guaranteed price targets. Instead, they're indicators or symbols that tie into larger mechanisms like the ComX rule 589, which regulates price fluctuation limits in futures trading, especially for metals like silver and gold. This is where things start to get interesting. The number 589 in XRP discussions may not be about the coin hitting a specific price, but could indirectly relate to broader market dynamics and liquidity flows. Over the next few parts, we'll break this down further. We'll look at how XRP's price structure interacts with market trends, explore the ComX rule 589 in simple terms, and examine how extreme movements in metals like silver and gold could potentially tie back to crypto markets. We'll also discuss supply and demand issues, global liquidity shifts, and what this could mean for investors and traders moving into 2026. By the end of this series, you'll have a clear understanding of the 589 theory, its relevance beyond price speculation, and the current market forces at play. Whether you're a crypto enthusiast, a trader, or simply someone curious about the intersection of traditional finance and digital assets, there's a lot to unpack. And I promise to keep everything in simple, understandable English without unnecessary jargon. Now that we've introduced the 589 theory and why it's more than just a number, let's focus on what's happening with XRP itself. When we analyze any crypto, charts are our first tool. Currently, the XRP chart is showing some interesting patterns, especially on the 4-hour and daily views. These shorter-term charts help us understand immediate trends, while the daily and weekly charts reveal the bigger picture. On the 4-hour chart, XRP is holding an uptrend. This is important because an uptrend shows consistent buying interest. Essentially, buyers are stepping in at higher levels than before, and that keeps the price climbing gradually. In simple terms, it means people are confident in the market at these levels, and the token is forming a base to build on. If XRP can maintain this momentum, we could see a smooth path toward reclaiming key levels. Speaking of key levels, $2 is currently a crucial price point. Reclaiming $2 isn't just a psychological milestone. It represents flipping past resistance into support. Resistance is like a ceiling that stops the price from rising, and support is like a floor that stops it from falling. Historically, when XRP has reclaimed $2 and held above it, it has paved the way for significant upward moves. For example, previous bases above $2 eventually led to price runs toward major highs. It's also worth noting the structure of highs and lows. Right now, XRP is forming a higher low on the daily chart. A higher low means that every new dip is still higher than the previous dip. This is one of the first signs that a bullish trend may be forming. The next step for a bullish structure is a higher high, where the price breaks above recent peaks. If XRP achieves this, it could signal a stronger upward trend. But technical analysis isn't just about numbers on a chart. Market psychology plays a huge role. Traders look for patterns, historical price levels, and momentum indicators to decide when to buy or sell. And right now, the engagement around XRP is strong. Social signals like viral posts and community discussions often coincide with price movements. When traders see hype or increased activity, it can trigger more buying interest, reinforcing the trend. We also need to consider market fundamentals alongside the charts. XRP isn't moving in isolation. Broader factors like exchange listings, partnerships, and liquidity play a role. For instance, if institutional investors start using XRP for liquidity management or bridging between fiat and crypto, it could increase demand. More demand can push the price higher, especially if the supply remains limited. This combination of technical patterns and fundamental developments makes XRP an interesting asset to watch. Another factor to consider is market volatility. Cryptocurrencies are naturally volatile, and XRP is no exception. Sudden swings can happen in minutes due to news, social media, or large trades. That's why traders often look for confirmation before making big moves. For example, reclaiming $2 with a strong daily candle close is more meaningful than a brief spike above $2. Daily candle closes reflect genuine buying pressure and indicate that the trend may hold. It's also worth looking at past trends for context. Previous periods of consolidation where the price moves sideways within a range often lead to explosive moves once the range breaks. XRP has historically shown this behavior. When it builds a base, the subsequent price movement can be strong because traders and institutions have more confidence in the token's stability. Finally, it's important to remember that charts are a tool, not a crystal ball. They help us understand what is happening and anticipate possible moves, but nothing is guaranteed. Technical analysis works best when combined with fundamental knowledge, market context, and an understanding of risk. For XRP, that means watching both the charts and developments like regulatory updates, partnerships, and liquidity events. Let's focus entirely on the 589 theory itself. For years, the XRP community has been fascinated by the number 589. Many newcomers assume it simply means XRP will hit $589 per coin, but that's not actually the case. The 589 theory goes much deeper and ties into traditional finance through something called ComX Rule 589. Understanding this is key to seeing why the number keeps appearing in different contexts and why the market pays attention. ComX is part of the CME group and handles futures trading for metals like silver, gold, and platinum. Rule 589 is a regulation that sets special price fluctuation limits for futures contracts. In simple terms, it's like a safety mechanism that pauses trading temporarily if the price moves too fast in either direction. For example, if silver prices spike suddenly, Rule 589 can trigger a short trading halt, usually lasting a few seconds. This pause allows the market to calm down, preventing extreme volatility or a flash crash. Think of it as a circuit breaker for metals trading. Now, how does this relate to XRP? The connection isn't direct in terms of price, but rather in terms of market dynamics and liquidity. The 589 references in XRP posts, viral images, and social media patterns may actually point to these broader market rules. The idea is that if a liquidity event happens, like Rule 589 being triggered in metals, it could shift capital into alternative assets, including digital currencies like XRP. Traders in the community interpret 589 as a signal of potential market shifts rather than a literal price target. This theory becomes even more interesting when you consider recent trends in metals markets. Silver, gold, platinum, and palladium have all been experiencing significant price rallies. Silver in particular has gone parabolic in recent months. Year-to-date charts show sharp upward moves, with prices pushing toward multi-year highs. The reason isn't hype alone. It's a real shortage in physical supply combined with growing demand. When demand outpaces supply, prices naturally spike, and that increases the chance of ComX Rule 589 being triggered. For example, global silver supply is tight. China controls the majority of production, and starting January 1st, the government will restrict silver exports. This means fewer ounces are available for international buyers, creating a supply crunch. Combine that with steady demand from investors and industrial users, and you get a perfect setup for price volatility. That's exactly the kind of scenario where Rule 589 might come into play. But there's more. Inventories of physical silver are also at historic lows. ComX warehouses have seen a drop of roughly 70% since 2020. London vaults are down 40%. And Shanghai inventories are at a 10-year low. When physical supply is tight and futures trading remains active, the market can experience extreme movements. These conditions are exactly why traders in the XRP community pay attention to 589. It's tied to real liquidity and market stress, not just speculation. Another angle is the paper-to-physical ratio in silver trading. For every 1 ounce of real silver, there are hundreds of paper claims on ComX. If a small portion of traders demand physical delivery, the system could face serious stress. Historically, markets in this condition often see funds or liquidity redirected to alternative assets, which in recent years has included XRP. That's where the narrative of XRP being ready to step in comes from in 589 discussions. It's also worth noting that social media and mainstream media reinforce this pattern. Posts featuring 589, viral images, or LED displays using 589 bulbs all create psychological reinforcement for the community. While these aren't financial guarantees, they build sentiment and engagement, which in crypto markets can influence actual buying behavior. Now that we've explained the 589 theory and ComX Rule 589, it's time to look at why metals markets matter for XRP and crypto in general. While XRP is a digital asset and metals like silver and gold are physical, the two are connected through global liquidity and market behavior. In other words, when big shifts happen in traditional markets, they can influence where money flows next, and that can impact crypto. Let's start with silver. This year, silver prices have been skyrocketing. In some cases, prices went nearly vertical, showing one of the largest moves in recent history. This isn't just hype or traders getting excited, it's real supply and demand pressure. Physical silver inventories are at extremely low levels. For instance, ComX warehouses have seen a 70% drop in silver since 2020, London vaults are down 40%, and Shanghai's reserves are at a 10-year low. At current consumption rates, some regions only have about 30 to 45 days of usable silver left. That's extremely tight, and it creates a perfect environment for price spikes. China, which controls the majority of global silver supply, is tightening exports starting January 1st. Companies will now need government licenses to export silver, and only large state-approved firms will qualify. This immediately reduces the amount of silver available on the global market. On top of that, rumors suggest that the U.S. could also restrict silver exports, further tightening supply. When global supply drops and demand remains high, prices naturally rise. This is a structural shortage, not just a temporary spike. Gold, platinum, and palladium are showing similar trends. Physical demand is outpacing supply in almost all of these markets. The result is rising premiums on physical metals, meaning buyers are paying extra just to get the actual metal. For example, in Shanghai, physical silver trades at about $80 per ounce. While ComX prices are lower, this price gap signals that there's a real crunch in tangible assets while paper contracts lag behind. This shortage and price gap matter for XRP and other digital assets because capital often moves to alternative stores of value during times of stress. If physical markets are tight, investors look for other ways to preserve wealth or maintain liquidity. Crypto, being digital, globally accessible, and fast, becomes an attractive alternative. XRP in particular is designed to bridge liquidity across systems, which is why the 589 theory connects it indirectly to metals markets. The idea is that if traditional markets face constraints, liquidity could flow into XRP as part of a broader financial adjustment. Now, let's talk about liquidity events. Recently, the Federal Reserve shifted its stance from tightening to providing liquidity. Banks received injections to stabilize the system, reminiscent of past crises. When liquidity is being added to traditional markets, investors often evaluate where to place assets for safety and growth. This is exactly the environment where XRP could benefit if it's positioned as a bridge or stabilizer in digital liquidity. It's important to highlight the difference between paper and physical markets. In silver, for example, the paper-to-physical ratio is around 356 to 1. That means for every ounce of actual silver, there are hundreds of paper claims. If even a small number of traders demand real delivery, the system could break or experience extreme volatility. These types of imbalances are precisely why Rule 589 exists, to pause trading during sudden spikes, but it also shows the fragility of traditional systems and why alternative digital solutions are gaining attention. Lastly, the overall pattern we're seeing is a massive shift in global finance. Investors are moving from fiat-based speculation into real assets, whether metals or digital currencies. This is not just a short-term trend. It reflects a growing understanding that the traditional financial system has structural weaknesses. Crypto, with its ability to provide fast liquidity and decentralized access, becomes an essential tool in this new landscape. First, let's look at liquidity. Global markets are interconnected. When physical markets like silver or gold experience shortages and prices move rapidly, investors naturally seek alternatives. That's where digital assets, especially XRP, come into play. XRP is designed as a bridge asset. It can move liquidity quickly between fiat currencies and digital markets. If a liquidity event occurs in traditional markets, XRP could see increased demand as institutions or traders use it to stabilize or transfer capital efficiently. This doesn't guarantee a sudden price spike, but it does position XRP as a strategic tool in times of market stress. Second, consider the market psychology. Crypto markets respond strongly to perception. Viral posts, riddle-like references to 589, and media coverage may not directly impact fundamentals, but they shape sentiment. When a community collectively believes in a potential event or trend, it can influence trading behavior. Even small price movements can become self-reinforcing if enough traders act on these signals. So, while the 589 references are not a literal prediction of $589 per XRP, they play a psychological role in how the community engages with the token. Next, let's tie this back to technicals. As we discussed earlier, XRP is forming higher lows and approaching key resistance levels like $2. If XRP successfully reclaims and holds above these levels, it creates a stronger foundation for future growth. Technical strength combined with favorable liquidity conditions in traditional markets could amplify XRP's upward potential. In other words, the charts provide the roadmap, while external events like metals, market stress, or liquidity injections can serve as fuel for the move. It's also important to keep risk in mind. Markets are volatile, and events like sudden regulatory changes, exchange issues, or shifts in investor sentiment can quickly alter price dynamics. While supply shortages in metals and Rule 589 events can create opportunities, they also carry risk. Traders and investors should focus on understanding these mechanisms rather than relying solely on speculation or viral posts. Knowledge and preparation matter more than hype. Let's consider a few practical scenarios. Scenario 1, liquidity stress benefits, XRP. If physical metals markets continue to face shortages and Rule 589 triggers occur, liquidity could flow into digital assets like XRP. This could result in a steady increase in demand, pushing XRP higher over time. Scenario 2, market sentiment drives. Price. Even without a real liquidity event, community engagement around 589 or viral content could create short-term spikes in trading activity. This is common in crypto and can lead to temporary rallies. Scenario 3, risk and correction. If markets normalize or liquidity pressures ease, there could be retracements. Even strong technical setups can see short-term pullbacks. It's important to recognize that crypto markets are reactive, not just predictive. Another key point is the interaction between digital and physical markets. As more investors diversify into crypto during times of traditional market stress, we may see digital assets becoming an increasingly important part of global financial flows. XRP's design as a bridge currency makes it particularly relevant in this evolving environment. In essence, XRP's potential isn't about hitting a specific price like 589. It's about being part of a broader financial ecosystem that's adapting to shortages, volatility, and structural imbalances in traditional markets. This is not simply a price target for XRP. The idea that XRP will hit $589 per coin is largely a myth in the community. Instead, the number 589 is linked to ComX Rule 589, which governs price fluctuation limits in futures trading for metals like silver and gold. This rule acts as a circuit breaker, temporarily pausing trading when prices move too quickly to prevent crashes and stabilize markets. XRP enthusiasts interpret the frequent appearances of 589 on social media, viral posts, and even mainstream events as a symbolic connection to market mechanics and potential liquidity shifts. Next, the technical side of XRP. The charts show that XRP is forming higher lows and approaching critical resistance levels like $2. Reclaiming these levels could establish a strong foundation for further upward movement. Historical trends suggest that building a base at key support levels often precedes major price moves. Combining chart structure with external market developments makes XRP especially interesting to watch. Then there's the metals market. Silver, gold, platinum, and palladium are experiencing significant upward trends due to tight supply and growing demand. For silver, inventories are at multi-year lows, and countries like China are restricting exports, creating a structural shortage. These conditions are causing physical premiums to rise and creating real pressure in global markets. When physical markets face constraints, liquidity often moves to alternative assets, and that can include digital currencies like XRP. Global liquidity shifts further reinforce this connection. Recently, central banks like the Federal Reserve have injected liquidity into the banking system, echoing past crises where traditional markets face stress. In these situations, investors look for stable, liquid assets to protect and move their capital. XRP, as a bridge token, is uniquely positioned to facilitate these transfers efficiently. While this doesn't guarantee immediate price surges, it explains why the community considers XRP an important player in times of market stress. It's also crucial to recognize the role of market psychology. Viral posts, images featuring 589, and discussions in online communities create engagement and awareness. These factors influence sentiment, which in crypto markets can translate into actual buying or selling behavior. While these signals aren't financial guarantees, they can amplify trends when combined with technical and fundamental factors. To summarize the practical takeaways, XRP's charts show promise. Higher lows and approaching resistance levels indicate potential bullish momentum. The 589 theory is symbolic. It represents liquidity events and market stress mechanisms, not a literal $589 price target. Metals markets are under pressure. Tight supply and increasing demand could trigger liquidity flows into crypto. Global liquidity injections matter. Central banks providing liquidity create environments where digital assets can gain attention. Market psychology amplifies movements. Viral posts and community engagement can influence sentiment and trading behavior. In short, XRP sits at the intersection of technical potential, market mechanics, and global financial shifts. The 589 theory captures attention because it ties all of these factors together in a narrative the community can follow. While there are risks and nothing is guaranteed, understanding the bigger picture allows traders, investors, and enthusiasts to make sense of market movements without falling prey to hype or fear. Going into 2026, the key lesson is this: focus on the structure, understand the fundamentals, observe global market trends, and consider how liquidity flows can create opportunities for digital assets like XRP. The 589 theory isn't about magic numbers. It's about recognizing patterns, market stress, and potential movement across both traditional and digital financial systems. By keeping a balanced view of charts, fundamentals, and market psychology, you'll be in a strong position to navigate the XRP landscape intelligently. Whether you're a long-term enthusiast or someone exploring digital assets for the first time, this approach helps you understand why XRP continues to be a focal point in the crypto world.